Another week has gone by and there's a flood of news and articles just like this one saying how the economy is still getting worse and we're heading towards the cliff end. As well as this, stock prices have been fluctuating up and down again, and this article in particular talks about the UK's short-term future, and it highlights Boris Johnson's concern about the coming downturn, stating it will be worse than the Great Recession in 2008. Here we saw the markets fall around 40 to 50%. So my kind of question is, if the market is heading towards a cliff, what's the point in investing now? And I also wanted to go a bit deeper into my portfolio and discuss my strategy. So starting off with this article here about the UK's short-term future. In my last video, in my portfolio update, I mentioned how I do want to diversify more and buy more UK stocks. But in the short term, it does have a lot of concerns. So namely, the economy is shrinking. So even before the lockdown effects were realised in the UK, the GDP has fell 2.2%, as you can see here. So it was the biggest drop in 40 years. So this means the economy is slowing down and getting bigger, which means there's less room for expansion, and that means companies tend to have less revenue and they can pay out smaller dividends and there's less share price growing. So I expect the full extent will be felt when the furlough scheme ends. So this is where the government is subsidising people's salary and paying them 80% of their wage to live off while they can't work. So when this does come to an end, households will have even less income. And this is on top, not just personal income, but also the government's reducing business loans. It means more business will go bankrupt and even more people will lose their jobs. Especially if the demand doesn't ramp up like people are hoping. I know pubs and hairdressers have opened up this weekend, and that means several different things. One, it increases the risk of a second lockdown. So for example, if not in Leicester, their whole city's been locked down again, which if this happens again more all over the UK, the stock market will crash all over again. Not to mention the US is hitting record highs in their coronavirus daily cases. However, I don't think this is, in terms of the stock market, I don't think it's too much of a concern, because I really can't see them going back and closing everything down and grinding everything to a halt again. I think they realise it is too severe and they can't afford to keep doing it. So going back to how I mentioned about how I do want to diversify into more UK stocks, so it's not just because of all the lockdown and COVID-19, but also Brexit looming is making me more cautious. So with this, I do want to invest in good companies and strong brands, preferably with an international presence to reduce risk of like one country's income. This is for several reasons. So like I said, if Leicester, for example, shut down again and it starts happening around different cities in the UK, if you have a company that sells worldwide and it's international, it really mitigates that risk. And countries that are doing better off or ignoring it, like the US, they're still generating income and revenue through them sources. So another good thing to focus on is companies that aren't as impacted by a bad economy and businesses that can operate regardless of a shutdown, or if the economy is a bit slower and consumers have less spending. So this comes from like boring companies. So this is quite stable. So like this is why I purchased National Grid. It's also more boring companies. I don't like supermarkets and stuff like that. Things that have necessities and aren't necessarily. I think Tesla's quite a good one to look at. I think if people's incomes do drop, it is such a hyped up car and it is just for the image. I think people really realise, and if they can't afford luxury cars, I think the stock price will just completely collapse. Especially Tesla, because at the moment it's at another record high. I think it is $1,200 or something crazy like that. So another good company, how I mentioned about not being affected by a bad economy and has several streams of income. One is Amazon. So while it does rely on consumer spending, it does offer the lowest prices and very competitively, so people will buy it with them regardless. Not to mention it's not Amazon's only income streams. So Amazon also operates stuff like cloud servicing, Amazon Prime and stuff like this. So the cloud servicing is a massive revenue stream for Amazon, and that's being paid for by businesses, and they're going to be, this is quite, cloud servicing in this day and age is a necessity. So businesses, as long as they're still running, that will be one of their costs that they keep and continue to pay. So a very strong British company is British Tobacco. So this is one I've recently upped my allocation of. This is because the price has dropped a bit further recently. So it currently is offering about a 6% dividend yield. And again, going back to if the economy collapses, they obviously have like a very loyal customer base. So they're very cheap right now, have a high dividend yield, and I think they have a customer base that will continue to buy regardless of the economy collapsing. So looking back over the 8 past years, as you can see, I think it's a very good buy right now. So I've upped my allocation just slightly, and as I put more money in, I will be having more of an allocation to British Tobacco. So outside of the UK, I'm also increasing my allocation in JP Morgan. So this is for a few reasons again. The main being the price has dropped. So since I purchased my pie in Trading 212, the price has dropped around 6%. So it's one of the biggest drops in my portfolio at the moment. So I want to average down on that and buy more of it whilst it's cheap. At its current prices, dividend yield is just under 4%, which is a very healthy amount and will provide a good income. Not to mention it has a lot of potential to bounce back up. So another reason why I'm going a bit big on JP Morgan is because I think it's quite risk averse. So they have a large cash reserve, so they can continue paying dividends even if they continue to lose revenue, which they have forecasted will continue to drop. So as you can see in this article here, it's dropped quite a significant amount due to the lockdown and coronavirus fears. So even though this has happened, they have forecasted for it and they've allocated a budget to deal with this. So obviously it's bad short term, but it's good to see it's being a responsible company and preparing for the worst event, and even more comfort in knowing it won't last. The coronavirus fears and this low price and troubling time for the company, it won't last forever and it will pick up in the medium long term. And while they're riding through this storm, they have all the cash to continue to pay dividends and to keep their business afloat. So that's why I'm averaging down on them and continue to buy a bit more JP Morgan. I think my allocation that now, I put it up to 6%, and this just is why the price is low. So as the price does jump up a bit, I'll probably lower the allocation again and give it to a cheaper stock in my portfolio when the time comes. Moving on to my portfolio, my overview, you can see in the dashboard here, I'm up again just around £1,000, around 9%. So not much has changed other than just putting in a bigger deposit. So I topped up from last week, only about £200. So I'm increased in my allocated percentage on the stocks that have dropped a fair bit, like I mentioned, JP Morgan and British Tobacco. So this is a strategy I'm going to adopt. It is a cost averaging approach, but it's more actively managed. So when I see a particular stock drop more, I will increase that stock's allocation to buy more of that given stock at a cheaper price. So obviously looking at the reason, when I do this, I will have to look at the reason why the price has dropped. Is it just for a short-term fluctuation, or is it something particular to that company? For example, if you had Wirecard in your portfolio and you saw it drop 90% because it's fraud and it's going to go insolvent and bankrupt, you might think, okay, yeah, I might not want to cost average on that. So obviously it's within reason, but if a stock does drop 6 or 10%, it could be quite a very good buy. Hence why I'm putting more into JP Morgan at the moment. So other than that, I will have another direct deposit going into my Hargreaves Lansdown ISA. So this is where I hold some of my index funds and other mutual funds. That's around £200 and that comes out around the middle of the month. So yeah, other than that, the portfolio is still pretty stable. I still do have quite a lot of my money in cash and in premium bonds. But again, like I mentioned, they are for the short term. Longer term, I am still putting all my money and investing into these stocks and shares. So to wrap this video up, there's always going to be a reason why you shouldn't buy stocks right now. And articles and news outlets, they get more views and hits when they are talking about serious things and scary stuff that can happen and catches people's attention. So you always need to take it with a pinch of salt and use your own thought process and your process elimination of what stocks you should and shouldn't buy. But there's never going to be a perfect time to invest. It's almost impossible to time the market. So if you're buying with a long-term strategy, planning to buy and hold, these short-term fluctuations, overall, they normally pattern out, and it does normally end up going upwards if you have strong companies in your portfolio. So this is why I'm not too worried about it. And of course, there will be people who say don't buy now, but you need to always apply it to your own strategies and your own investment goals. So do bear that in mind when you do see these news outlets. So anyways, so thanks for watching. Do let me know how these kind of news and all the media is affecting your portfolio, and if you have made any changes at all, if so. So thanks for watching, and I'll catch you guys next time.